Okay, for this video, I wanted to cover a simple example as to how to complete a 1040-NR, which is a individual income tax return for a non-resident alien. So in this example, what we have here is we have John Doe. He's a Cayman Islands citizen and tax resident, so he lives there full time. So he's not a U.S. person in any respect. However, he has investments in U.S. businesses which require him to file this return. So what we're going to do is I have a full 1040-NR. We'll go through this for John. And then I also have a slide here which covers some of the background information on who needs to file and under what circumstances. And then we have the fact pattern for John himself. Okay, so if we're starting at the top here, who needs to file this? Well, generally, the 1040-NR is filed by a non-resident alien individual. It can be filed by a non-resident trust or estate, but more often than not, we have these filed by non-resident individuals. And normally it's because of one of two types of filing obligation circumstances. So the first one is the non-resident is engaged in U.S. trade or business. So we'll talk a little bit more about that later, but effectively what this means is the non-resident has opened a business in the U.S., and they have created a sufficient amount of nexus with the U.S. to be subject to tax in the United States. Okay. Now, the second obligation here is if the non-resident has U.S. source income not connected with the U.S. trade or business. This is often called U.S. source FDAP income. FDAP is fixed, determinable, annual, or periodical income. This is U.S. source dividends, interest, rents, royalties, those types of payments. And so if the non-resident has these types of payments and not all of the taxes were withheld at source, then the individual needs to file, okay? So let's look at some examples here to kind of drill down on what we're trying to get at. The first one for the U.S. trade or business issue. So we have John. He's a German citizen. He's a German tax resident. And he decides to open a Delaware LLC, and he's going to be the sole owner. Now, by default, a single-member LLC is a disregarded entity for federal tax purposes. The LLC opens an office in the U.S. and it hires an employee, right? Now, because of those activities, opening a U.S. office, having a U.S. employee, the LLC is now going to be engaged in U.S. trade or business. So John, as the sole owner of this disregarded entity, he needs to file a 1040-NR to report the income, the expenses, and then pay taxes on whatever the net profits are. So the second example here for the U.S. FDAP issue, we have Adam. He's a Bermuda citizen and tax resident, and he decides to open a Delaware C Corp. This C Corporation generates $100K in profits, and it pays $21,000 in taxes. So after the taxes are paid, the after-tax net profit within the corporation is $79,000. The C Corp distributes a dividend to Adam of $20K. Now, the Delaware Corporation is the withholding agent in this context, right? So you have a Delaware Corporation paying U.S. source dividends to a non-resident. The Delaware Corp was required to withhold taxes. FDAP rate is 30%, right? So 30% times the $20K in dividend. It was supposed to take out $6,000 in taxes and pay the difference to Adam. However, the corporation didn't do that, right? So it didn't withhold the tax, it didn't report this on a 1042-S, so it missed its filing obligations. If this happens, then now Adam, the recipient, is obligated to file the 1040-NR to report the income and pay the tax, okay? So let's look at the fact pattern here for the 1040-NR that we're going to be going through. So we have John Doe. Remember, he's a citizen and resident of the Caymans. And John decides that he's going to open a Florida LLC to purchase a rental property in the United States, right? So he buys a property in St. Pete, Florida. And again, the Florida LLC is 100% owned by John, so it's a disregarded entity for federal tax purposes. Now, owning rental property in the U.S. creates two issues. The first one is you have U.S. source FDAP income, which are the rental property receipts, right? The more favorable kind of tax treatment here is the non-resident can make an election to treat that as effectively connected income with the U.S. trade or business, which means that John now has to file a 1040-NR to report the income, the expenses, and then pay taxes on whatever the net rental profits are, okay? So that's the first triggering event for why John needs to file this 1040-NR. So let's look at the second bullet point here. John, during the year, he also opened a brokerage account with a U.S. broker, and he's trading U.S. publicly traded stocks, right? So Tesla, Apple, whatever it might be. His account for the year shows that he had capital gains from the sale of stocks totaling $6,500, and he received U.S. source dividend income of $1,500. Now, the U.S. source dividends were automatically subject to withholding tax of 30% by the broker, right? So the broker knows that John's a non-resident, so they took 30% off the top, so they withheld $450, and they deposited the net amount of $1,050 into John's account. Now, capital gains for the sale of U.S. stocks by non-residents are not subject to U.S. tax. And this is because under the federal tax rules, when you sell stock, it's treated as a sale of personal property, and personal property is sourced to where you are physically present when you sell the asset. In this case, John's a non-resident, so selling the U.S. corporate stock creates a capital gain, but it's not subject to U.S. tax. Now the dividends, John does receive a 1042-S from his broker, shows that he had $1,500 in gross U.S. source dividends, and federal income tax withheld of $450. Now, the last bullet point that triggers a filing obligation for John. John, during the year, he also opened a Wyoming C Corporation. Now, the Wyoming C Corporation had $50,000 in taxable profits, so the corporation had to file a Form 1120, that's a C Corporation federal income tax return. It paid $10,500 in taxes, which is 21%, and it left an after-tax profit of $39,500, okay? Now, the C Corporation then decided it's going to distribute a dividend to John totaling $10,000. Now, because John is a non-resident, the C Corporation is required to withhold 30% in taxes and then pay John whatever the net difference is. Now, like our example above here with Adam, the C Corporation here failed to do that, right? So again, John maybe didn't know this was required, so he paid the dividend, and then he talked to his tax advisor afterwards and said, hey, your C Corporation had to do this, you didn't do it. So the C Corporation failed to do this, so now John has to report the income and then pay the taxes on his 1040-NR, okay? So now let's look at the 1040-NR, and then we'll go through each of these three bullet points, and I'll show you how everything needs to be reported on the return. So if we start with page 1 here, pretty straightforward at the top, right? We have the name, the taxpayer here, the ITIN, and then check for individual. Foreign address is obviously okay, right? John lives in the Cayman Islands, so he can use his Cayman address. And he does indicate here that he is a single taxpayer, meaning he's not married, okay? Now, it does ask the question here, did you trade any crypto during the year? In John's case, no. He's not in Bitcoin or Ether, so he can answer no for that question. Now, the first page of the 1040-NR is reporting income effectively connected with a U.S. trade or business. So what we see here on line 8, this is going to be the amount that's coming from the rental property. Okay, so we'll look at that in a little more detail later, but when you look at the 1040-NR, page 1 is income that's effectively connected with a U.S. trade or business. The U.S. source FDAP income is not reported on page 1, okay? If you have U.S. source FDAP income, there is a separate schedule, NEC, where you report those amounts and the amount of tax that needs to be computed, okay? Page 2 is where the taxes are summarized, right? And then you see at the bottom whether you have a refund or taxes owed. Okay, so what we want to jump to first, I want to jump to Schedule E for the rental property, okay? So here is Schedule E. It's titled Supplemental Income or Loss, but this is where you report in Part 1 any rental property income. So what we have here, you remember John bought this rental property in St. Pete. Okay, so we have his St. Pete address, type of property is 1 for single-family residence, and then the fair rental days, 180 days rented during the year because he bought it midway through the year. Okay, Now, rents received, there's the $12,000 amount, and then he adds all of his expenses, right? So you have expenses for cleaning, maintenance, insurance, and then he does capitalize the property and depreciates the building portion. So the amount of depreciation expense for the year is $1,667. So when everything is said and done, the net profit he has is down here on line 26, $3,183. This is the amount of income that is subject to tax at the graduated rates, right? So this is the amount of income that is treated as effectively connected with a U.S. trade or business. Now, as I noted earlier, highlighted this, is when you have a non-resident invested in U.S. real estate, the rents are actually treated as FDAP income by default. So if you want to report the rental income and expense using this treatment here to be taxed only on the net amounts, you have to make an election with your tax return to treat it as ECI. And so within the return, if I flip down here, you can see the election I have for John Doe. What we've done is we have elected to have items of income treated as effectively connected with the U.S. trade or business. And so the reason why we've added that is because we're saying, look, we have U.S. source FDAP income via the rental income here, but what we want to do is rather than be subject to tax 30% on the gross amount, we're electing to treat it as ECI so we can take deductions here and then pay tax on the net amount. I have a separate video which covers that election, so I'll put a link below. But it's very, very important that you always make that election with the return, because otherwise the IRS will actually disallow these deductions. So revert to the default treatment, which is just paying tax on this $12,000 amount. So we've got the income, the expenses, the net amount of $3,183. So if we go back to page 1 here, this is where you're seeing this amount, right? So it's actually coming from Schedule 1. So let me flip down there really quick. So Schedule 1, we have rental real estate, royalties, partnerships, S-corps, etc. There's that $3,183 number, and so that number flows up to page 1, which again, this is where we report income effectively connected with the U.S. trade or business. Okay, so that's where we have the rental income amounts being reported. Now, if we go back to the slide here, the second item is John opens a brokerage account with the U.S. broker, right? So he has the capital gains, $6,500, and the dividends of $1,500, and then the Wyoming corporation issue where he got paid a $10,000 dividend, but didn't have any taxes coming out. Okay, so where are these amounts reported? Well, on the 1040NR, when you report U.S. source FDAP income, it's on the 1099, sorry, not the 1099, the 1040NR NEC. So tax on income not effectively connected with the U.S. trade or business. So we have the nature of income here, the various categories. The one that we're going to be dealing with here is 1A, right? Dividends paid by U.S. corporations. And then they have various columns here, 10, 15, 30, and other. The reason why they separate these is because 30% is the default rate. Okay, so that is the default FDAP income tax rate. However, you could have amounts subject to lower rates because of tax treaties. So for example, if you were working with the US-UK tax treaty, you might have an income amount here that is subject to either 15 or 10%, or even sometimes it's 0 or 5. And so if you have a rate that's other than one of these three, you can enter the income in one of these columns and then put the appropriate percentage there. In our case, because John is a Cayman Islands tax resident and the Caymans don't have a tax treaty with the U.S., we know we're always working with the default rate of 30%. So that's why the dividends that we have are going to be in this column C here. Now, the dividends paid by U.S. corporations, remember, we have $10,000 coming from that Wyoming C Corp, and then we have $1,500 coming from the broker. So that's why we see the total here, $11,500 reported on line 1A in column C for the 30% FDAP rate. Now, what the return is required to do is we calculate 30% times this amount, and this is the total taxes owed, $3,450. Okay, so $3,450 is the required amount of tax to be paid on that U.S. source FDAP income. Now, if we go up to page 2 of the 1040, here's where we get the total amount of tax reported on the non-ECI, right? So 23A, there's the $3,450. So that's the taxes that John was required to be paying. And note that, remember, if we look at let me flip back here really quick. We had $1,500 of U.S. source dividends, and $450 was withheld in tax by the broker. You get credit for the amount of tax that was already withheld. So the $450 paid by the broker, Form 1042S here on line 25G, there's our $450. So of the $450 that he owes in taxes on this non-ECI U.S. FDAP income, he is getting credit for $450. So he only owes the difference of $3,000, right? And remember, that $3,000 is a result of this third bullet point here. He received a dividend distribution of $10K, but the C Corp did not withhold the tax as it was required to. So now John has to pay the $3,000 personally, rather than already have it come off the top when he received the dividend distribution from the C Corp. So there's where we get the $3,450, and there's where we take the credit for $450 from what was already reported as the on the 1042S, the taxes withheld by the broker. Okay, so when you add everything up, right, the $318, that's the tax owed on the ECI. So the $3,183, if we look at the marginal tax rate tables, he owes $318 there. He owes $3,450 related to the U.S. source dividends, and so the total $3,768 minus the $450 credit that he gets for what was already reported on the 1042S. So the total balance owed is $3,318. Okay, so that's how the numbers are flowing. Now I want to go back quickly to some of the other schedules here. If I go back to the NEC, so we're reporting all the dividend income up here, but note here the capital gains and losses from exchange of property. Now remember, he sold some stocks during the year and made about $6,400 in capital gains. You don't report those here, right? So even though he had capital gains from the sale of property, you would only report those here if they were going to be subject to U.S. taxes, okay? So in this case, none of that is being reported here because none of those gains are subject to tax, so you can leave them blank, okay? So the second schedule that's important to cover is the Schedule OI. So every 1040NR needs this. A lot of this just has information on whether or not the taxpayer becomes a tax resident. So in this case, we have John Doe, right? He's a citizen and resident of the Cayman Islands, right? So A and B, pretty straightforward. And then questions C, D, and E, right? So he's not a U.S. citizen. He was never a green card holder. And then the type of visa he has, he doesn't have a visa, right? So he's not present in the U.S., no U.S. immigration status. That's kind of the default placeholder you can use if you don't have any kind of visa currently with the United States. And then the other questions down here, question G is very important. What they're asking here is how many days were you coming in and out of the U.S.? The reason why they ask this, and then line H as well, because if you as a non-resident spend too many days in the U.S., you can trigger what's called the substantial presence test. The substantial presence test means that if you're in the U.S. for the calculation is 183 days per year, you become a U.S. tax resident. Even if you're in the U.S. on, let's say, just a tourist visa, you can still trigger this tax residency test under the substantial presence test, which means that now you're actually not filing a 1040NR. You've got to file a 1040 as a U.S. tax resident. So what they're asking here is you to calculate the number of days, because if your days are too high, then this return doesn't even work for you. You've got to be filing a 1040 now. Okay, so a couple other questions here. Just answer yes or no whether they apply or not. Right. So total compensation, 250K or more during the year, no. There's item L here for income tax treaty issues. Again, remember, John is a Cayman resident. There's no tax treaty, so we can leave that off. And then in question M here, this is very important. So it says check the applicable box if. M1, this is the first year you are making an election to treat income from real property located in the U.S. as ECI with a U.S. trade or business under Section 871D. That was the election I was referring to earlier. When you have U.S. rental real estate income, the rental receipts are treated as U.S. FDAP income, but you can make an election under 871 to treat it as ECI. And in this case, we're doing that, right? We are not reporting the rental receipts as U.S. FDAP income. We're reporting it as ECI, so we're making this 871D election, and we're checking that appropriate box, okay? So let me just run through this, make sure I've covered everything. So we have Schedule E here. We've been through that. The 4562, don't need to go in in too much detail, but this is where you report the depreciation expense for the property. So we have residential rental property, month place in service. The basis, we were saying $100,000 for the value of the property that's subject to depreciation, so 27 and a half years. Mid-month convention, straight line, so the amount of depreciation for the period was $1,667, pretty straightforward. And then we also have a depreciation schedule there. Again, nothing too complicated here. We separate so the whole property was bought for $125,000. The value of the land was $25,000, which is not depreciable, right? Land is not a depreciable asset. And we have $100K assigned to the value of the building itself. That is the depreciable piece of the property. Okay, so let me just make sure I've covered everything here for you so I haven't missed anything. I'm pretty sure we've got it all. Yep, so we've got the taxes, everything reported there. Let me just go back to the slide really quickly. I think we've covered it all. So I hope this was helpful. If you have any questions, please leave me a comment below. And I look forward to seeing you again on the next video. Thank you so much for watching.